Joining me now to talk more about the second half of the year and the early days of this third quarter is Bob Iaccino. He's a chief market strategist for Path Trading Partners. Bob, great to see you bright and early this morning down there in Naples, Florida. How does this market look to you at these levels?
Well, I think it's taking a what we'd call a well-deserved pause. I was a little surprised to see us get to new all-time highs this quickly. I think the issue with it is that we still don't really know what the trade deals are going to look like. We obviously have this July 9th deadline, which I guess now is pushed to August 1st in reality. And that seems like President Trump is trying to give himself a little bit more leeway to make the deals that he knows the market wants to see. And because of that, the market's a little bit on edge this morning, but I really don't call it any sort of panic by any stretch of the imagination.
I would say probably most notably then the next event could be this earnings season, Bob, and we are expecting companies to report results just within the next few days or so and in the weeks to come. What do you anticipate from corporate America?
I think we're going to see quite a few warnings in terms of earnings going forward. I think what we're seeing right now is an economy that is clearly slowing, not necessarily pointing to a recession at this stage, but it is clearly slowing. We're seeing that across several metrics. And then one of the metrics that bothers me more than anything is the manufacturing PMI figures, whether you look at the national level or you look at the sort of individual ones. Philly Fed was better this past week, but it was still in the negative 12 and change is what I saw, even though it was an improvement from the prior figure. And those have a really good history, these manufacturing PMIs, although we're not a manufacturing economy, they really correlate to overall stock market performance. So if you don't start to see recoveries in those indices, it's going to be difficult to say that the new all-time highs are going to last that long.
What is the best way then, Bob, with the sum of these parts to position yourself in this market?
Well, shockingly, I actually like consumer discretionary, which kind of goes against what I just said. But when we're looking at the ETF, for example, the XLY is a good example. It's breaking out to the upside, and this might have something to do with wages still improving at the margins. Not as strong as it was a couple of months ago, but still improving overall. I think that has something to do with the level of deportations we've seen. When you looked at the jobs number, we saw a decrease in the foreign-born labor force by over 500,000, and that's allowing employers, or I should say forcing employers, to give raises to the existing employees. The last thing you want to do is lose employees and watch that quits rate improve because of the availability of jobs at whatever level you're talking about. So I like consumer discretionary. One of the ones we like the most is Roku, especially with the new release of the Bear season and them renewing it for a fifth season. That's going to help Roku over the medium term. They have a good pricing structure versus their competitor. And again, they're showing the ability at least to produce independent or individualized content like the Bear that you haven't seen a lot of success other than maybe Squid Games with Netflix.
So we saw what was a historic V-shaped recovery in the second quarter. Trade obviously is still a topic on the forefront of many traders' minds, including down here on Wall Street, Bob. Do you think we could see more volatility ahead? How are you preparing for that?
Well, I look at the tariff situation a little bit differently than other people. I don't see it as inflationary. I see it as a tax, and taxes are deflationary. And what I mean by that is I think tariffs are likely to slow the economy more than consistently raise prices. If you get a one-off in price increase, what you get is a slowdown in consumption. You don't get an inflationary cycle or an inflationary trend. So I see this as more of an economic slowdown and a factor taking place globally, not just here in the U.S. So I do think we'll see more volatility in the stock market and in the trade deals. You know, you look at the situation, for example, with Tesla and with Elon Musk and President Trump, two of the most volatile personalities on the planet are feuding, and that's causing volatility in Tesla stock. When you talk about President Trump versus some of the world leaders he's trying to negotiate, you have a similar dynamic. So I think you could see stresses based around trade. And if they don't get that settled or get even if it's just a blanket level of tariffs across the board, and then individualized deals with individual nations, however high they are, let the market know what that is, and the market will figure it out.
Treasury Secretary Scott Bessent saying earlier that several trade announcements are ahead. Bob, when we look at the second half, so the next 6 months or so between now and year end, do you think the S&P 500 is higher by the end of the year?
I actually do think it's higher. So Scott Bessent is one of my favorite people in the administration. He's probably one of my favorite Treasury secretaries ever to this point. And I think with his pedigree and his depth of knowledge, he's the kind of person who could work around this volatility and straighten out some issues that we have. He's already said or implied that he's not going to extend the duration of the Treasury issuance. And that's a good thing for stocks. What we have seen is when we get higher long-term yields, which we will get if he starts issuing more 10-year and 30-year, that's bad for the stock market. So overall, I think for this year, the S&P is going to be higher at the end of the year than it is now.
All right, giving us some optimism this Monday morning. Bob Iaccino, always appreciate you joining. Bob's the Chief Market Strategist for Path Trading Partners down there in Naples, Florida.